So the S&P 500 on average is set to return around 10%, which is really not too shabby. For some people, that just doesn't seem to be enough. But there are actually ways how we can double or triple the S&P 500 returns. However, there is a catch to it. And that's why in this video I want to talk to you about the concept of leveraged ETF, which is a topic that has been getting more and more popularity. So it's very similar to a regular S&P 500 ETF that you invest your money in, let it compound over time and grow over time. Here you would pick an ETF provider that offers a leveraged ETF on the same S&P 500. So they still follow the same S&P 500 movements, but with leverage. And they usually do that in two ways, either by borrowing money from the bank to have more money to invest on investors' behalf, or they use CFD option trading, some kind of derivative to get that amplifying effect. So most commonly there are 2x ETFs and 3x ETFs that basically amplify the returns by either 2x or 3x as the name implies. And if we head over to just ETF, you can find it over here on the ETF screener. You go down at the bottom over here and you will find short and leveraged ETFs. Now right away, when you click on that, you will see a disclaimer warning you of the potential risks attached to it. And obviously we'll speak about it because nothing in life is ever safe. But for the sake of this exercise, let's go ahead and click confirm. And here we'll see basically the biggest leveraged ETFs out there. And obviously right now the biggest one is based on the S&P 500. And that's exactly what I want to focus on in this video because it's most common, right? You could also track some other things over here, but that's the biggest one in terms of fund size. And obviously fund size always matters. So that's something, I'm really particular about. But even that fund size is really, really small compared to the actual S&P 500, right? There we talk about billions. Here it's millions, significantly smaller, which already probably gives you an idea that it may not be that popular due to some reasons I'll come to in a second. And that's a 2x, as you can see over here. It will basically double your investable amount, which can work well if times are good, but obviously there are certain risks to that. And another thing to keep in mind, obviously the expense ratio is much higher, right? Because those companies, they don't do that for free. There's more work that needs to be done in the background. So obviously it takes more labor and so forth. So it's significantly higher. On my S&P 500 ETF, I pay 0.03. Here at 0.6. So that obviously comes also out of your returns. Now, if I go into this over here, now that's the biggest one on just ETF. There are obviously other ETFs out there. There's just one I picked. And obviously it's accumulating reinvested dividends. It's swap based. So it's not really buying the underlying assets. That's also something to keep in mind. Usually I prefer holding the actual assets in my ETF, right? That really buys the real underlying assets, all those stocks that are inside the S&P 500. Here it's swap based, so it's some kind of derivative, not the actual underlying stocks behind it. And yeah, in my eyes, the fund size is really on the smaller side. Right, so just to demonstrate to you a very simple example, let's imagine you start investing $100 into the S&P 500, right? And on the first day, the S&P, the actual S&P, increases in value by 5%. You would have a new value in your portfolio of $105, right? Pretty straightforward. Now, 5% daily increase might be on the higher side, but let's just take it for the sake of this exercise. Now, the 2x leveraged ETF in this example, right, which you would go for in the case I just shown you before, that over here, but of course, there are also other options out there. In this case, if the S&P goes up by 5%, that would technically go up by 10%, right? Because it's a 2x leverage. It's a lever, basically. You get more for less investable amount. So here your portfolio value would all of a sudden go to $110 instead of $105. That's incredible, right? Instead of making a $5 profit, you have a $10 profit. So that's obviously the main appeal of using leveraged ETFs and in general leveraged trading, right? Trade with more money than you actually have available. That's amazing and it's really cool, and a lot of people like it for that. And yes, if you're a short-term trader, I think you can really capitalize on some nice daily price swings and movements. However, as great as it is in times of increasing share prices, actually when the markets drop, it works against you in an even worse way. Let me show you what I mean. So here we're back at the same example, $100 starting capital, but now the markets drop. The S&P 500, let's say, for the sake of this exercise, I know it's a very excessive number, but just for you to get the principle, it works the same with smaller numbers. But let's imagine it drops by 15% in a day. That would be really, really dramatic, of course. So now the new value of your portfolio would, of course, be $85. Now the 2x leveraged ETF in this case would drop by 30%, right? Because we amplify both up and downside. So now your portfolio would only be $70, right? A massive correction. Now, of course, hopefully next day it will recover a little bit, right? The prices always go up and down in stocks and ETFs. It never stays flat. So next day, hopefully we'll get back to $100. So in order to get back to your initial capital, the S&P 500 now has to increase from $85 to $100. That equates to an increase of 17.65%. So see, just because something drops by 15%, it has to increase even more than 15%. If you were only to increase by 15%, it would be less than $100. So the growth has to outperform the drop of the previous day, basically. Now the leveraged ETF now has to go from $70 to $100, which basically would be an increase of 42.86%. That's a huge increase, right? And more importantly, it's actually more than twice. You see here, even if the S&P was to increase by 17.65, again, hypothetical example, double that would be what, 35 something percent. Here, it has to outperform even more than twice X to get to the same starting base. So here you can really clearly start seeing the problem of those leveraged ETFs. They're great in positive times, but they're not so great when the market drops and falls or actually stagnates, goes up and down in a day. And that's because they reset on a daily basis. So every single day they start new calculations of their returns. And that's why you really got to be hammered in times when the markets drop. You see here basically those swings, price swings, right, really being amplified, as you would think, by 2x. But over long term, while the S&P may be slightly down, your overall leveraged ETF will be down significantly more. And that's what we call volatility drag, where basically that volatility really works against you. If it was going up in a straight line, the S&P, you would get double returns. Amazing. I would definitely go for it. Absolutely. I would go for 5x, right? But we know that even the S&P 500 can have multiple years of declining market, right? So in that way, your returns would really be hammered. And I would really caution anyone to really put significant funds in there. And that's why you also see the biggest UCITS ETF right now only having a fund size of 374 million. While on the contrary, one of the most popular S&P 500 UCITS ETF has a fund size of 37.5 billion. So a major difference over there. And it just shows that obviously people are more comfortable investing in the actual underlying assets. And as it shows over here, I also prefer a full replication because I know that my ETF provider actually owns those underlying shares. And also keep in mind an extreme example, if you were to have a 3x levered ETF on the S&P 500 and that S&P 500, again, in an extreme case, whatever it might be, some kind of black swan event and something happens in the world, the markets absolutely collapse and the S&P drops in one day, because we talk about daily resetting, right, by 34%, that would mean a 3x on that is over 100%, which basically means you will be wiped out and your position could be completely gone and closed. So that's another risk, right? And again, the question is why to take that risk when already technically the math is against you. So in general, I'm really not a big fan of using leverage or margin trading in the first place because I only believe in losing money I can afford to lose, right? Worst case, I lose the cash that I have. So while I don't use leverage for trading or investing, of course, I also do like real estate. And here I think it can be very strategic to use leverage in a way, which you do by having a small down payment and the rest you borrow from your bank, right? It's a very similar principle. The big difference is the house, the market value of the house is not priced daily. If there was something bad going on in the neighborhood and the house would temporarily drop in value, it's not that my bank calls me up and say I need to provide more collateral or more down payment to sort of justify the value of it, of the loan that they gave me against the house as a security. But here it's really a long-term play, right? So long-term, I generally believe that where I invest, the market value goes up, right? And the same with the S&P 500. While I know that there's short-term fluctuation, long-term, I'm going to be in good hands. The same with the house. And the house is not priced daily. That's a big difference. While here, those leverage ETFs, they are reset on a daily basis, and that really works against you. For anyone who wants maybe slightly higher returns than just the boring 10% of the S&P 500, which I generally think is actually really healthy. But I understand if you're young and you want to take a bit more risk, I personally really recommend keep the majority of your money in a low-cost diversified index fund. That can be S&P 500, that can be a global world ETF. There are different options out there. And then have maybe 5, 10, 15%, up to a maximum, I would say personally, 20% of your total investable amount in a more risky and speculative portfolio where you can try out different things. Maybe you want to dabble around in the crypto markets, right? Maybe you want to buy some individual shares that have potentially slightly higher risk, but also slightly higher returns, right? I think that might be a smarter approach than putting your money into a levered ETF. I personally would really stay away from that. Really exciting announcement that I have to make, that the Smart Money Club that I've been running now for almost a year, I have now opened it up for anyone to join free of charge. Yes, without any cost that you can join. You can follow along, stay in the know and connect with like-minded people. Of course, there's still a premium area also. If you ever wish to upgrade later on, you can do that for additional perks and benefits. But on the free access area over here that you can see, I think you get some great value out of it. So definitely use the link down in the description below to join the Smart Money Club free of charge. And I can't wait to see you on the inside.